Hello everyone, welcome to the video. Today we will be answering the question, what are stock options? This is a video targeted for beginners, so if you are planning to start trading options or just started trading options, I feel like this is a video for you. I think you'll find it very beneficial. If you are an intermediate or an advanced options trader, this is probably not the right video for you. If you're doing iron condors and jade lizards, then probably this is not the right video for you. So this is a video mainly for people who are beginners, and I will try to simplify it as much as possible. We will not be using the insurance analogy. There are a lot of videos on YouTube where they compare options to insurance. While it makes sense for put options, I feel like that analogy kind of falls apart when you're talking about call options. So I will not be using the insurance analogy. If you want to proceed that way, there are plenty of good videos on YouTube that discuss it accordingly. Also, I'd like to mention that we will not be taking margin into account, as in throughout the explanation of this video, we will assume that you don't have margin available in your account, and we will be discussing those things accordingly. Okay, so let's get started. What are stock options? Options are derivatives, as in they are derived from stocks. They're like stocks, but not exactly stocks. So think about this thing right here. If stocks are this white printer paper, then these green and yellow Post-it pads are options. They are like this piece of paper, but not exactly that. Also, like the size of these Post-it pads compared to the size of the printer paper, options are usually cheaper than individual stocks. Also, what we can see from here, there are two kinds of options. There are call options and there are put options. So, what's the difference between call and put options? We will start off with call options first. A call option says that I promise to sell 100 shares of ABC stock. It could be any company. We're just going to use a fictional company, ABC, just to make it simple. 100 shares of ABC stock at X price on Y date. So we have it written right here. Okay, and just like stocks, you could buy or sell options. In order to buy options, all you need is the dollar amount in your brokerage account to pay for it. So if you want to buy a call option or a put option, and say the price of one option contract is $150, if you have $150 in your account, you are able to buy that call or put option. Now, when we go into selling the call or put option, it gets a little more complicated. But before we get into that, let's discuss what are call and put options. So, derivatives is a fancy word, but if I want to simplify it, I would just say that call options or put options are contracts. That's it. They're contracts. They're not stocks. They're not ETFs or bonds or anything like that. They're contracts. Okay? So, what does a call option say? In terms of contracts, a call option says, I promise to sell 100 shares of ABC stock. It could be any company. We're just using a fictional company, ABC, for the sake of this video. It could be Apple, Google, your favorite company. Doesn't matter. I promise to sell 100 shares of ABC stock at X price on Y date. So let's take a look at that. Okay, so that is a call option. A put option says, I promise to buy 100 shares of ABC stock, could be any company, at X price on Y date. Okay, and you basically decide which date and what price. And we'll get into that in a second. So that's all call and put options are, okay? And this promise is being made by the seller of the option, okay? And that's what it says contractually. Imagine this is a contract, okay? So if you are going to promise to sell someone 100 shares of a certain stock on a certain date, on a certain price, you would need to have 100 shares of that stock that you're promised to selling them. Okay, let's imagine there are 100 pages here, and each one is a stock of ABC company. So we have 100 shares over here of company ABC, and we are selling a call contract on these 100 shares. Basically, we are making someone the promise that we will sell these 100 shares of this company on a certain date at a certain price, okay? And we sell this call contract to someone who's willing to buy this, and we do that. And since we sold this call contract to someone, they pay us a little bit of money for that, okay? Just like that. A put option says that the seller, as in I in this case, promised to buy 100 shares of ABC stock at X price on Y date, right? Now, if I'm promising to buy 100 shares of stock from someone, what do I need to buy 100 shares of stock? Money, right? So, we need to have enough money to buy 100 shares of ABC stock. As long as we have that in our account, we can sell the put option. Okay? So, imagine we promised to buy 100 shares of ABC stock, and the X price, the price that we say we'll buy it at is $200, okay, on a certain date, say a month from now. So we promised to buy 100 shares at $200 per share. So we would need 100 times 200, $20,000 in our account to sell one put contract. Something to note is that all option contracts are 100 shares per contract. So if I sell one contract, this is talking about 100 shares, okay? Not 99, not 101, okay? 100 shares, always. That does not change. If we need to promise to buy more shares or promise to sell more shares, we could sell 2 of these contracts. So then we're talking about 200 shares. But each contract is always 100 shares. Okay, so let's come back to the call option we just talked about. Okay, we promise to sell 100 shares of a certain company stock on a certain date at a certain price. So, let's say I have 100 shares of company ABC. Currently, it's at $200, and I bought them at $200. When I sell this call option, I decide, you know what? I will sell these shares at $220 per share. I bought them at $200 each. I will sell them at $220. And I will do that a month from now. So bought them at 200. If I could sell them at 220 in a month, that's 10% profit. That's great. I'll take it. Okay. So I sell a call option where it says, I promise to sell 100 shares of ABC stock at $220 per share a month from now. Okay. And I charge them a certain amount of money for it. Very good. So I sell it. There's someone out there who buys it. Okay. Now, two things can happen, right? Scenario one, the stock on Y date, when this option expires, okay? The promised date is the expiry date. Remember that. So on Y date, which is a month from now, the stock can be trading above 220 or it could be trading under 220. There are two possible scenarios. So let's look at the first scenario first. The stock is trading at $230 when Y date arrives, which is the expiry date of this options contract. So it's trading at $230. The person I sold this call option to thinks, hey, the market price of this stock is $230. He promised to sell me the stock at $220. So he's making a $10 profit per share if he utilizes this call option. So he comes back to me and he shows me this piece of paper and tells, hey, you promised to sell me this stock, 100 shares of that, today on the Y date, today's Y date, and you promised to sell me that at $220. Now the market price can be $230, $240, $250, does not matter. I promised to not sell him at $220 per share, and that's what I'll have to do. So the brokerage, they would utilize this contract, or in technical terms, they will exercise this contract. This contract would go away, and I'll have to give away my shares to the person who exercised the contract. And I sold them at $220 per share, so my shares would be taken away from my brokerage account, and they would pay me $220 per share and 100 shares, so $22,000 would be deposited in my brokerage account. I hope that makes sense. If it does not, please rewind the video and rewatch it. It's very important that we understand this concept. Now, scenario number two. Same call option that we sold. We will buy 100 shares of company ABC's shares at $220 on Y date, which is a month from now, right? But when Y date comes, instead of trading above $220, the shares were trading at $210. Now, I promised to whoever bought my call option that I will sell them my 100 shares at $220, right? Y date is here. Now, whoever owns this now is thinking, he promised to sell me his shares at $220. But currently, these shares are going at $210. So why would I buy these shares from him at $220 when I can buy it from the market at $210? That doesn't make any sense. This contract, it's worthless. And that's exactly what happens. If on Y date, the shares of ABC is trading under the price that I promised to sell them at, the call option becomes worthless, okay? And the X price at which I promised to sell him my shares at is called the strike price. So to recap, the Y date, when you could exercise the contract, is the expiry date of the contract, and the X price, at the promised price that I promised to sell my shares at is called the strike price of the options contract. Now, I understand that some of the concepts may not be as straightforward, as options contracts are like nothing that probably you've ever traded before. So if you have any questions, leave them in the comments below and I'll get to them. And if you know someone who might benefit from this video, feel free to share this video with them. Now, let's talk about put options. So, put options, okay? Put options promise to buy 100 shares of a certain stock on a certain date at a certain price, right? Now, we already talked about the agreed upon price is called the strike price, and the agreed upon date, which is the Y date, is the expiry date of the contract. So, what do you need to sell a put option? Just enough money to buy 100 shares of the stock at the strike price, okay? So we will use the same example. If you promise to buy 100 shares of ABC stock and the strike price is $220, you would need 220 times 100, $22,000 in your account to sell one put options contract. This is not $22,000, but I thought I'd use it as a prop just to have some visual representation. So, as long as you have that money in your account, you can sell a put option. And let's look at the different scenarios. Just like with the call options contract, in the put options contract, there are two possible scenarios. When the expiry date comes, as in the day you promise to buy the shares from them, okay? There are two possible scenarios. Scenario number one, the price of the stock of company ABC is above the strike price, okay? So if you promise to buy it at $220, it could be trading above $220, or scenario number two, it could be trading under $220, okay? So let's take a look at scenario number one. We promised to buy it, 100 shares of ABC stock at $220 per share, once again, a month from now, okay? And that date arrives, and shares of ABC is trading at $230 per share on that date, the date the contract expires. Now, the buyer who bought this put options from us is looking at it and thinking, he promised to buy 100 shares of ABC stock at $220 per share, but the share price in the market is $230. Why would he give those shares to us, allow us to buy his 100 shares at $220 when he could just turn around and sell it to whoever he wants to in the market at $230? Doesn't make sense, right? Which means this put option is now worthless. Scenario number two, the Y date or the expiry date arrives, and now the shares of ABC company is trading at $210 per share. So the person who bought this put option from us is thinking, he promised to buy 100 shares from me at $220 per share, but in the market, it's going at $210. So I can make more money by selling it to him for $220 than selling it in the market for $210. So then he exercises this options contract, okay? And we have to buy those shares at $220, and the money that we promised him that we would buy at $220, so that $22,000 is taken out of our brokerage account, okay? And given to him because now we're buying the shares from him, so we have to pay them for the shares. So that is basically how that works. Now, there are a lot of different concepts and a lot of different strategies that you can do with options. The sky's the limit when it comes to options trading. But what we discussed right here is the very foundation, is the very building blocks of all these different strategies, and kind of the first step towards the whole new world of options trading. So if you are not clear on the concepts that we discussed here, I recommend you go back and re-watch this video. If you have any questions, feel free to leave them in the comments below, and I'll do my best to answer them as soon as possible. And if you like this video, give it a thumbs up, and if you enjoy contents like this, you might want to consider subscribing to the channel. Also, if you want me to make videos on options trading on a certain topic, leave them in the comments below as well. If I get enough responses, I'll probably make a video on that as well. Hope you guys have a great day. I'll catch you in the next video. Bye-bye.